It seems as though inflation has caught the Fed completely by surprise. The central bank met today and left interest rates unchanged, and the Fed's path is quite uncertain. We have two very clear examples of how strong inflation still appears to be. We're also going to show you what the futures market is now predicting. Today, Federal Reserve holds interest rates at 23-year highs, citing lack of further progress. They have lack of further progress on inflation, returning to its 2% target. Furthermore, Federal Reserve Chairman Jerome Powell said it's unlikely the next policy move will be a hike. Moreover, in recent months, there's been a lack of further progress towards the committee's 2% inflation objective, and the FOMC characterized the economic outlook as uncertain. It will take now longer than expected for the Fed to reach the confidence that inflation is moving sustainably down to 2%. He says, I don't know how long it'll take. Powell also made the case that monetary policy is positioned to address different paths the economy might take, one of which involves no cuts. On the other hand, if policymakers were to become more confident inflation is moving sustainably down to 2%, or if the labor market were to unexpectedly weaken, those scenarios could build a case to reduce interest rates. Funny, this is the first time in recent history the Federal Reserve is now talking about the idea of a weakening labor market. Two examples of surging inflation. Number one, home prices. They climbed by 6.4%, hitting new record highs. This is a Case-Shiller Home Price Index on a year-over-year basis. We see a surge of 6.4%. It's the highest in a year. It's the highest in a longer period of time, actually. In fact, we have to go back to November of 22 to see the Case-Shiller Home Price Index at these levels. The real estate market has certainly been a beneficiary of our surging inflation. We also see inflation in the U.S. labor costs, and this is not good news. They rise by the most in a year in a sign of wage pressures. This is a quarterly number. It was just released. It's the Employment Cost Index. It provides labor cost changes. It specifically tracks the cost of employees to employers. How much does a business have to spend on wages? And it has a direct influence on monetary policy because it speaks directly to the rate of inflation within wages. Now, it's affecting certain sectors quite dramatically. Number one, leisure and hospitality. Also, accommodations and food services. So, when we go to hotels, restaurants, things of that nature, service driven industries, that's where we see a lot of the costs, and it's really no surprise. We also see a lot of inflation in the wages directly linked with transportation and warehousing related to the manufacturing sector. So when we talk about the Empire State Manufacturing or the Philly Fed, perhaps this is a reason why manufacturing is so weak because of all the inflation in transportation and warehousing. Now, just last year, we saw accommodations and food services. They rose by 9.5%, leisure and hospitality rising at 8.9%. But more recently, again, the transportation and warehousing sector, this is where we now see the fastest rate of increase in the wage inflation. We have predictions from the futures market. These are the Fed funds futures in purple. The probability the Federal Reserve will not cut interest rates in green. The probability the Federal Reserve will cut rates by 25 basis points. In June, there's a 9% chance of a cut, 91% chance Federal Reserve's not cutting rates in June. It's most likely also not cutting rates in July, 24% chance of a quarter point cut, 74% chance we're not cutting rates. September, we're probably still not cutting rates, 41% chance of a quarter point cut. However, November is the pivot point because at this point, we only have a 37% chance the Federal Reserve will not cut rates. There's a 43% chance of a quarter point cut, and there's an outlier. We may see more than a quarter point cut. And in December, a 21% chance the Federal Reserve will not cut rates, 40% chance of a quarter point cut. It's important to note that the pivot point now is November. That represents the first meeting where we have better than a 50% chance the Federal Reserve will cut rates. Based on the next few economic reports, especially the non farm payrolls later on this week, it'll be interesting to see if the pivot point moves. If we see the numbers are quite bleak, for example, in the non farm payrolls, and the chances that the Federal Reserve will cut rates sooner than November, well, certainly I think the financial markets may react to that in kind. There are also alternative economic barometers that show us signs that inflation is certainly not subsiding, one of which is M2. It's the US money supply. We took a deep dive into the data, and it shows us actually something very unusual. We're now seeing surging M2 alongside with high interest rates. It's a very unusual phenomenon, and I think you're going to find our analysis quite intriguing.